Okay, so as you already know, the homework assignment is due tomorrow. Please upload it to Blackboard before 4 p.m. I'll have the next homework assignment posted that you can begin. I haven't exactly decided when the due date on that will be, if it's going to be the original schedule or pushed back. So I'll let you know when I get homework 6 posted, but homework 5 due by 4 o'clock tomorrow. Today we're going to be talking about incremental rate of return analysis, and this is a really important technique that's used for comparing multiple alternatives. And so it's very useful, and the same principles can be applied, similar principles can be applied to for-profit projects, which is what we're going to be looking at today, as well as similar principles are applied when evaluating non-profit projects where you're actually losing money and have more costs than revenue, but where sometimes there are social factors that would motivate you to undertake the project. So kind of the underlying idea of increments, which is comparing differences, is very powerful. Before we get into the material for today, I wanted to remind you about the Career Expo. This is going to be held next Wednesday over in the Student Center. And there's more than 155 companies attending, including more than 20 that are looking to hire engineers. Even if you're not near graduation right now, I'd recommend that you go over to that and just start to get a feel for what's available and who the companies are, where their projects are. Begin collecting business cards, hand out your resume. It's really a good idea not to wait to the last minute if you're looking for a job.
Is this for only Marshall people?
It's for Marshall students, alumni, and people from the outside community can come, but I mean, I don't know that they're widely advertising this event outside of Marshall, but you know, if you know someone who's not a Marshall student, it's still okay for them to go.
Okay.
Yeah.
Is this just a STEM job fair?
No, it's a job fair for all different disciplines. The Office of Career Education has the full list of companies. I've got the list of engineering employers here. But if you want to look at the full list, we can pull it up real quick.
Is there a career fair for just STEM?
No, this is the only career fair that they'll have this spring. They used to do them on different days. Now they've got it all on the same day. So, yeah, so the list of companies that they've got is really pretty extensive. And I think probably there's more than 20 employers. Like they have it broken down by, you know, if you click on engineering here, they've got the engineering employers. But I think honestly, they may have missed some because.
We're going to be there?
Well, they were last time, because you've been to the Career Expo before, right?
Yeah, I was there last spring.
Yeah.
I was wondering, but I thought it was just a STEM one. I don't know.
I don't see, I mean, I see the U.S. Army and healthcare recruiting, but I don't see the Army Corps specifically.
Well, I'll see if it's too late to register.
I don't think it's too late. I think people were registering up until maybe 2 or 3 days in advance before, but if you want to call Career Education and see if they still have tables, it'd be great to have the Army Corps represented.
The students have to register?
No,
We just show up?
you just show up. So it's from 3 to 6, and the recommendations that the Office of Career Education has, I think, are pretty valuable. I went over there last time, and I mean, I guess I wasn't surprised, but I was a little disappointed at how many students were there just like in t-shirts, you know, like you don't have to wear like a 3-piece suit or anything, but it's also good to wear maybe a shirt with a collar or something that buttons up. It just seems like if you're trying to make an impression on a potential employer, then as the Office of Career Education puts it, dress for success. It's also a good idea to bring resumes. I mean, I know that seems maybe a little bit old-fashioned in the day of LinkedIn, but there will be some old-fashioned people there with really great jobs, and so, you know, handing them their resume, I think, will set you apart from students who are just there walking the aisles without any kind of resume. And then another, I think, really effective habit is if you collect business cards and then like later that evening, email the people who you're actually interested in maintaining a contact with, just thanking them for coming to the career fair, saying that you enjoyed the brief discussion. then that's a way for them to have your email on file, and it probably is just like another way to kind of express your interest in a position. So there's lots of opportunities there. It's never been a better time to be graduating from college than right now, honestly. In spite of the fact that people are predicting that there's going to be a recession, for whatever reason, the job market is still really strong. So you guys are spoiled with opportunities, absolutely. I remember when I was graduating and entering the job market, it was pretty thin. And I sent my resume out to all the companies in the area, and I felt very fortunate because I got 2 interviews. So anyways, so Career Expo, next Wednesday. I'd encourage you to attend. Now, we've previously learned about the internal rate of return. And the 2 big drawbacks of the internal rate of return. Number 1 is that it assumes all of the earnings are going to be reinvested. So it assumes that there's compounding of the interest at either the rate that the profits were generated or some secondary account which has the same interest rate. So because of that, sometimes it doesn't apply, but then the other issue is that you can't compare alternatives using the IRR alone, because there are situations when the project with the highest internal rate of return doesn't necessarily give you the most number of dollars. So don't get fixated on maximizing some abstract percentage when really what you want to maximize is the number of dollars that you're getting. I mean, because that's what you can spend. You can spend dollars, you can't spend percentage, not directly. So if you're sometimes in the analytical position of comparing alternatives, what you're going to want to choose is the project that gives you the most money. So we'll do an illustration of that, the comparing IRRs with this data. So let's just say that we've got project A and project B, 2 different projects, and you can see that one is more expensive than the other. They each have some net revenue over time. So in this illustration, I'm just going to put this data into Excel and show you why it's a good idea to use internal rate of return for initial screening, but you wouldn't want to rely on it for decision making. Okay, so if you're following along, feel free to begin a new Excel file. We'll have 2 illustrations and 1 in-class exercise today. And what we're starting off with is, it's given here that our MAR is 4%. And then we're going to have year, project A and project B. And they all go through 10 years. Both of the options have the same duration. And then the project A is the one which we have an initial outlay of $50,000. Project B is an initial outlay of $85,000. And then project A, we would receive net income of $9,000 every year for 10 years. Whereas project B gives us a net income of $14,000 every year for 10 years. All right. So we can very easily calculate the internal rate of return for each of them using the IRR function. Remember, the hard way to calculate the internal rate of return is you find the present value of each alternative and you keep changing the interest rate until you find what interest rate gives you a present value of 0. Because that's the definition of internal rate of return, is balance between inflows and outflows. So what is the interest rate where the inflows and the outflows are equal? That's the definition of internal rate of return. So we could either do it manually or equals IRR and let Excel do that heavy lifting in the background. So we just select the range of data starting with the first number would be our outflow, the subsequent numbers are the inflows, and so in the IRR function what it does is it's recognizing this as some amount that's already at the present, and then it recognizes all of these other amounts and it's finding internally what interest rate is required to make it so that the inflows and the outflows are equal. So let me just expand the digits here a bit. So 12.41% is the IRR for project A. And if I just drag this cell to the right, I don't have to type the equation again. I can just see down here at the bottom where that square is a little bit thicker. If I just drag it to the side, then it applies the IRR. So it looks like project A is more profitable. Like if you didn't know the warning, you might be forgiven for thinking, oh, we should choose project A because higher interest rate is better, right? But that's not necessarily our criteria, and that's not how we use IRR. The way that you use IRR is for initial screening. And so the correct use of it is to say, yes, project A is acceptable because the IRR is greater than the MAR. And then, yes, project B is acceptable because the IRR is greater than the MAR. So we use it for initial screening, and both A and B pass the initial screening. They're both acceptable options. But which one is more profitable? If this is a mutually exclusive alternative, we can only do one of the options. So should we do the option with the highest internal rate of return? Not necessarily. Let me show you how we can prove that to ourselves. Have I taught you the NPV function before?
Net present value.
Net present value, that's right. So let's find the net present value of each of these alternatives, including the cost. So to do the NPV function, just as a caution, anything that's already in the present goes outside the NPV function. Only put future values into the NPV function. So equals NPV. So it's asking for a rate at this 4% interest rate. And now we're going to start with the amounts that are in year 1, year 2, year 3, and so on through the future. So only the future amounts are in the NPV function. We close parentheses, and then any amount that's already at the present, you add outside of the NPV function. So then what that will do is it'll tell us the sum of all of the amounts when taken to times 0. So the net present value of project A is $22,998, and the project B value is $28,552. So we should select project B. It gives the most profit. So option B is the most profitable. So how is it possible that it is more profitable but it had a lower internal rate of return? That seems like a discrepancy. So why is it? And the answer just goes back to how much you had to spend at the beginning to get into either of these projects. It's, would you rather earn 12% interest on $50,000, or would you rather earn 10% interest on $85,000? So it's better to earn a slightly lower rate of return on a larger amount. So it requires the larger upfront investment, that's true, but this added $5,000 of revenue that you're getting every period more than makes up for the difference in cost between the two alternatives. Okay, so the key points, just to reiterate, number one, the correct use of internal rate of return is for initial screening. Both of these are acceptable. Our criteria says that the minimum should be 4%. So they both exceed the minimum. But what we can't use the internal rate of return for is selecting the best alternative. We have to either use net present value analysis or incremental analysis, which is what we're going to talk about today, which is just a separate technique for identifying the best option. And also the advantage with incremental analysis is it tells you what's the rate of return on the difference in cost specifically. So I'll tell you what that means in just a bit. But are there any questions about this illustration before we move on? All right, so save that, maybe create a new tab, because we're going to do another illustration here in a moment. What we've done is we calculated the IRR for each of them. We saw project A had the higher rate of return, but when calculating the present worths, project B had the better present worth. So we should select the one that gives us the most dollars, which is project B. Now, this last part. If you must borrow money at the MAR, explain what does the present worth represent. So these present worths that we calculated, that is what fraction of the profits are yours to keep when you've already taken into account the money that you are paying in interest. So it's the present value of your share of the project, because there's going to be a certain amount of this money that's going to service the loan, and so the net present value is telling you the present value of your share of the profits. Okay, now increment. Increment means difference. Incremental. So calculation of incremental cash flow. Let's say, for example, that there are two options, option A and option B. Just in this brief illustration, the option B is more expensive. You can see that it costs an extra $20,000 per year compared to option A. But it seems like the benefit of doing that is then its annual cost is lower. So it's less expensive to maintain. You're paying more up front, but it's costing less to maintain, and then it seems to have a greater salvage value out there in the future. So the increment is the difference between the two. So the incremental cash flow is the more expensive option minus the less expensive option. So this column is the increment, and so you'll see it's option B minus option A. So minus 60,000 minus negative 40,000, so that's like adding 40,000. So then the net increment here is negative 20,000. So that means that the difference between B and A is you pay an extra 20,000 up front, and then you receive an extra 6,000 each year in annual revenue. Basically, a reduction in costs is the same thing as an inflow. And then there's an extra $2,000 in salvage value. So the question is, should we pay the extra $20,000 in order to get that $6,000 in recurring annual cost? Ben?
Why is the $6,000 positive if it's the higher number minus the lower number?
It's because it's the higher number in terms of the upfront cost. So it's still option B minus option A. So it's 19,000.
It's consistent throughout.
Yes.
Okay.
It's not for each row, it's the more expensive minus the less expensive. We order the columns by the first cost. That's a great question. Are there others? So we put the cheaper alternative on the left, the more expensive alternative on the right, and then this third increment column is simply the more expensive upfront cost minus the less expensive option. And then hopefully there's some justifiable reason for option B being more expensive. And so it may be more revenue or lower costs, but the annual revenue should be positive in order to justify that added cost. So this column on the far right is the increment. It's the incremental cash flow. So what we want to do is we want to calculate the rate of return on the difference between the two options. And if the rate of return on the difference is greater than the MAR, then we should choose the more expensive alternative. That's the decision criteria for incremental analysis. the decision criteria is that you should always choose the more expensive option as long as that incremental cost is yielding more return than your minimum attractive rate of return. So if you can buy a chainsaw for $100 and a different chainsaw for $200, you should spend the extra money if the other chainsaw is going to allow you to have more profits, more revenue at a level that exceeds the minimum attractive rate of return. So always we're going to be comparing alternatives, starting with the cheaper option and then working our way through a list of increasingly more expensive alternatives. Now let's just go through some terminology, because the letter I in particular has been used so many different ways this semester. I think it's important for us to be really clear and specific on the different ways we've used the letter I. So the first time that we used the letter I was when talking about interest, and capital I means the interest amount. So it's not a percentage, it's the number of dollars. So interest amount. And so that would be the interest rate times the principal would give you the interest amount that has to be paid. Lowercase I is when we're expressing it as a percentage, so interest rate. Now I star was the variable that we assigned when we were talking about rate of return. So the rate of return takes into account compounding effects, and when you are reinvesting the funds back into the project, then I star can be described as the internal rate of return. Last time, on Thursday last week, we talked about external rate of return, and there was the external rate of return I apostrophe that takes into account the external reinvestment rate, I sub I. So the external reinvestment rate is the given, so it's the interest rate that is on that external account where all of your profits are going in the meantime, and you use the external reinvestment rate in order to help you calculate the external rate of return. And finally today, we're going to be calculating delta I star. And so the delta means increment. So it's the rate of return on the extra investment, or the increment between alternatives. So that's a lot of different uses of the variable I. But hopefully that summary helps to sort it all out and keep it straight. All right. So let's look at this next alternative comparison, where what we're trying to find out is between option B and option A, is it worth spending the extra $13,000? So you can see that $73,000 is the cost of option B, $60,000 is the cost of option A. Should we spend the extra amount if our MAR is 10%? Okay, so in this next tab, we're going to start off by defining our MAR. In this case, it's 10%, so 0.1. We'll have the year, option A, option B. Ben?
Will option B always be more expensive? Will it be set up that way, or will we see cases where we'll have to change it around?
It'll definitely be changed around.
Okay.
Like, you may be on the phone with an equipment supplier who gives you the most expensive bid first, and then you call someone else and they give you a bid that's in the middle. So oftentimes the data will come into you out of order. And in fact, today's in-class exercise, I've intentionally scrambled the order of the data so that you have to put it in cheapest on the left, then increasingly more expensive as you move rightward. Good question. All right, so we've got 4 years that we're looking at, and option B is the one where we're going to pay $60,000, whereas option A, we're paying $73,000. And then option A would give us a net revenue of $22,000 per year. Okay. Now, let's do that same thing as before, just for practice. Let's calculate both the NPV and the IRR, starting with, I guess, the IRR. Let's do an initial screening to make sure that they're both acceptable. Are both of these alternatives acceptable? So using the IRR function, looks like 17% for option A, 16% for option B. So what's the interpretation from the standpoint of initial screening? They're both acceptable. So let's just type that out. Let's type the interpretation. You know, just a spreadsheet full of numbers isn't enough. We have to have like a description of what's our conclusion, what's the assessment. Okay, so since both option A and option B have IRR greater than the MAR, they are both acceptable alternatives. Okay, so they pass the initial screening. Now, which one to select? Well, let's do this incremental analysis to find out. Okay, so we're going to have B minus A in a column. And I put a space in here just to help break it up a little bit. I mean, you don't have to, but I just find that spacing things out for this incremental analysis makes it easier to distinguish between the given data and the increment. So equals the amount in B minus the amount in A, and drag that down. Okay. I guess maybe I should have put my notes here, because I'm going to want to calculate the IRR again for the increment. I had my note in the way. So here I want to have equals IRR of the increment. And so what that's saying is that we earn 11.4% interest on the extra $13,000. So the general rule that I've said to you before, the decision criteria, is keep spending each additional dollar as long as the rate of return on that additional dollar is greater than the minimum attractive rate of return. So here what we've seen is that the extra $13,000 that it costs to buy option B instead of option A, that yields a return of 11.4%. So they both pass the initial screening. Let me put the analysis of the incremental, well, interpretation of the incremental analysis. Since the IRR of the increment, 11.4%, is greater than the MAR, 10%, we should select the more expensive alternative and go with option B. So according to this, we should choose option B. We have another way of knowing which option is better, and that's to do the NPV. You'll never get a conflict between the present value method and the incremental method. They'll always tell you which option is best, and it'll always agree. So let's just check that to make sure that the present value method will give us the same interpretation. So NPV, and remember with the NPV function, we're only going to select those amounts that are in the future, and then outside of the NPV function, we'll add the amount that's already in the present. So NPV, discounting not at the IRR, using the MAR for our NPV discounting. Put the amounts that are in the future, and then add the amount that's already at the present. So it agrees. This told us option B is the best choice, and this told us option B is the best choice. But we got more information from the incremental analysis. The incremental analysis told us specifically what's the rate of return on the extra amount. That extra investment of $13,000. Sometimes people will drag their feet. They won't want to spend the extra amount. They just want the cheapest alternative. You know, people will want to, I don't know, buy the Hyundai when they maybe should think about buying the Honda. Or they'll think about, I don't know. Cheaper equipment doesn't always save money in the long run. And so what this incremental analysis does is it allows you to say, that extra investment you're going to have to pay, like, what's the rate of return on that? Okay, so does everybody feel comfortable with the idea of the incremental analysis so far? Where things get tricky is when there's more than two options. So you're really going to have to pay attention for this next part, because you don't want to miss kind of the order that we do things. So the overall rule is if the internal rate of return of the difference, meaning the difference between two options being compared, is greater than or equal to the MAR, then the additional investment is justified. So it doesn't have to be greater than the MAR. It can be equal to the MAR, because remember, the MAR is acceptable. All right. Let's say that we've got 1, 2, 3, 4, 5 options. I've already put it in order of least expensive on the left and going increasingly expensive. I really ought to do this though, so that you can't see everything yet. Because when you start off, you'll run the initial screening. So here I've calculated the internal rate of return of all of the options, and you can see that all of them have an internal rate of return of greater than 18%. So each of these are potentially suitable, but the question is, which one should we do? We don't know what's the matchup always going to be for all of them up front. All we know is the first matchup, which is comparing B versus A. So what I mean by matchup is it's a comparison each time between two alternatives. So our first comparison is B versus A, but we don't know what the next comparison should be until we find which of the options is best in B versus A, because it might turn out that option A is better than B. And if option A is better, then that means our next comparison would be C versus A. So we don't know at the beginning anything other than the first matchup is going to be cheapest and second cheapest. So here you can see that in the B versus A comparison, B is better. Okay, so now we know that our next matchup is going to be C versus B. But it might have been that A was the more profitable option, and so our second matchup could have been C versus A. All right, so we know that the next one is C versus B. Okay, so we do the incremental analysis for that one. And what we see is that since the internal rate of return on the increment of C versus B is greater than the MAR, so 43% is greater than 18%, So then that means now our favorite option so far is option C. Okay, so we've done 2 comparisons totaling 3 different alternatives, and so far at this stage in our thinking, we like C the best, but we still have to look at D and E. Okay, so the next matchup, we only know one at a time. We're comparing D to C. Now finally we have a curveball, because in the D to C comparison, it turns out that the incremental rate of return is 0%. So the extra cost of D is not justified. So we still like C better than D. So our final comparison is going to be E versus C, because we threw out option D when its incremental comparison showed that it wasn't worth spending the extra $5,000 that D costs compared to C. So our last matchup is E versus C. And the interpretation, since the internal rate of return of the increment is less than the MAR, we don't like C either. I'm sorry, E. E's no good because the rate of return on its increment is only 14%. And for us to accept it, it would need to be 18% or higher. So we should keep option C. So the conclusion is option C is the best here in this lineup. Okay, now it's your turn to practice. This is kind of, you can think of this as a template for the comparison that you're going to do. You're going to do a comparison where we're comparing heavy equipment, and you know each of the pieces of equipment will last for 10 years, and it has a MAR of 12% for your company. And we know the annual revenue for each option. And so what I'd like you to do is, first of all, do initial screening. So just calculate the IRR for both of them, for all of the options for the initial screening. So, you know, in this one, we calculated the IRR first, and we checked to make sure that they're all acceptable. And then something that's not acceptable, we wouldn't bother doing an incremental analysis if it doesn't pass the initial screening. So here, in part A, I'm asking you to identify for each of these pieces of equipment which is acceptable. So you're going to have to sort it out in the order of least expensive to most expensive after throwing out the alternatives that have an IRR that is rejected. And then the incremental analysis we're going to do one at a time. And you remember, you can't do all of the incremental analysis titles like the column headers at first. You only can do it one at a time. So I'm asking you just for consistency to use the first letter of each of the alternatives to label it. So there's C, K, V, H, D, and A. So don't use numbers, don't use letters. Well, use letters, but don't do like A, B, C, D, E, F. Do the letters that are listed there for the alternative. And then this is kind of the structure of what your spreadsheet should look like in the end. But remember, this part on the right, the incremental analysis, you just do one column at a time.
It's better if we put it like from least to...
Cheapest on the left and increasingly more expensive. Yeah, exactly.
Is there a reason why we would compare each one individually instead of just calculating the NPV and seeing which one has the highest?
Yeah, it's if we wanted to know the justification for the added amount on a specific basis. Like if we wanted to know the rate of return for the difference or the added cost. Because you'll always get the same answer, but sometimes you want more information. You want like kind of the detailed why it's better.
And like you said, the NPV analysis basically always confirms your incremental rate of return analysis, right?
Yeah, that's right. So my first comparison is C versus D. And since the IRR is less than the MAR, reject C. The extra amount is not worth it. So the next matchup is H versus D. Again, we calculate the IRR. This time it's above. IRR is greater than MAR. So V versus H. The IRR here is going to be negative because if you add up all the revenue, it's only $7,000, which is less than the $15,000 acquisition cost. So IRR less than MAR. Reject V. Final matchup, A versus H. Okay, so we looked at it by the present worth analysis and the incremental analysis. And either way we look at it, the Hitachi is the best option here. It's the option that gives us the most profits. And if we look at Hitachi versus the second best alternative, like if they were all sold out of Hitachi, then the second best alternative would be, what was our last comparison? Hitachi versus Deere. So our second best alternative would have been the Deere, because it's the one that gives us the second highest present worth of the project when everything's discounted at the MAR. So that's incremental analysis. The increment is the difference between things. And that's one of the big insights of engineering economics, is that you don't compare things by focusing on what they have in common. You can ignore the things that they have in common and compare things based on their differences. And so here, where you've got two alternatives, what you want to do is you want to find out the rate of return on the difference between them. And if the added investment will give you a yield that's higher than your minimum, then the added investment is justified. Any questions before we conclude for today? Okay, that's it. Remember that the homework assignment is due tomorrow by 4. See you on Thursday.